Ladies and gentlemen of the crypto space, we're live on a Monday, May 6th at 11:31 a.m. I got my DR shirt on today. Was at my daughter's school. Family day. Much a pleasure, much a pleasure. Always enjoyable. Um, Today is a very simple story. There's always a deal being made, and I think that's of everyone's interest, what is actually going on and what deals need to be made to actually keep the system functioning. So Bitcoin popped over the weekend back above 60,000, up towards like 64 and change. That is obviously in response to dollar weakness, but it's not dollar weakness, it's other currency strength. But technically, mechanically, it's impossible for other currency strength to be there. It's not the way the system works. There's too much dollar demand. Dollar demand implies dollar strength under all circumstances. There is no scenario in which the world is absent dollar demand unless a deal is being made. So I think we're on the almost past the threshold of a structural dollar deal that's required in order to keep the system functioning by providing adequate dollar supply. So by looking at the Bitcoin chart, that's the last place you're going to get some insight into what the Bitcoin chart is going to do. Bitcoin is obviously a manifestation of excess money in the system, excess currency in the system, because if the currency was needed, it would be being used would be would, for the purchasing of goods, services, consumer staples, businesses activity, capex, opex, so on and so forth. So this is what people often talk about in terms of savings. Savings is by definition an excess, and you're able to accumulate it and use it for future consumption. So in many regards, that seems it's important to mention that seems not. I question the concept of saving, and is it really a natural part of a financial system? Should capital be carried into the future? Work done today, carrying that work into the future and using it for future consumption? So that is an interesting philosophical question. I don't want to digress too much. So I guess the point is, last place to look on the chart for where the price of Bitcoin is going is the actual Bitcoin chart, which is why historically, prior to recent market activity, 2024, maybe late 2023, we started talking about these markets more because they were exciting again. We talk more macro. And in that regard, over the weekend, we pushed below 105. So had a big run up, big dollar spike heading into April of 2024, in which basically Japan intervened in the yen. They call it the yen intervention. And it makes perfect sense. There's no way for the dollar to go down when you can borrow at 0 to 0.1% and lend at 5%. I mean, listen, y'all in the crypto space, and that's exactly what you do. It's carry trade 101. If you borrow an Aave for 5% and lend it for 15%, you're going to do it. So now you take it to the trillion-dollar level of nation states. That's exactly what they do between Japan and the United States. So this has been going on for decades, and at this point, it's come to a threshold where it's unsustainable. Japan is back up against the wall, and the only direction is down. And it's fighting U.S. domestic monetary policy interest, and it's fighting the capacity for Japan to raise interest rates because they can't. It's just not mechanically possible. The numbers no longer crunch. There's two paths. There's many paths forward, and it's all about what are the odds. Everything is all about odds. So what are the odds that Japan just lets their currency continue to fall, 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 and fall? The implications of their currency falling and falling and falling is that everything internationally gets more and more and more expensive. So their devaluation of the yen is quite consumer price inflationary with regard to anything that's imported into the damn country. So that clearly isn't sustainable. Um, so how the hell do they strengthen their currency? They can't. There is no way to strengthen their currency other than actually an implicit threat. And that's kind of where we are. The implicit threat is that if their yen is depreciating, consumer price inflationary pressures are mounting. How do they strengthen the yen? They have to sell their savings. And their savings happens to be in U.S. Treasuries and whatever the net international investment position, which is very positive. They have a lot of stuff around the world. They're one of the most NIIP positive countries on the planet. They've spent the last decades buying up shit all around the world. So what happens when you start selling shit to bolster the yen? One, there's only a certain amount of savings that they have, and two, it starts to depreciate the shit that they're selling. So what's probably the most liquid thing that they're selling, or that they can sell to sustain their currency? U.S. Treasuries. There goes the interest rate on U.S. Treasuries. What does U.S. domestic policy say? Interest rates are too high. We're about to blow up the U.S. banking system. In fact, we've seen banks blow up, and the only reason they haven't rippled into a viral type of event is because of intervention, FDIC intervention. So I don't think domestic policy wants that to occur. You think? So they don't want long-term interest rates to go up uncontrollably because the yen is depreciating and Japan is backing up their currency. So how the hell could they prevent this? So really, the intervention is just basically stabilizing things until the title of today's stream can actually be executed. The deal. There's always a deal. And Japan historically is the recycler, fancy term, of U.S. long-term debt. Um, Japan buys our debt, which allows us to finance U.S. fiscal policy. And if you haven't noticed, U.S. fiscal policy is through the roof. They're borrowing more and more and more and more to the tune of what? Run rate of $2 trillion for 2024. And they need to refinance $10.8 trillion worth of rolling debt that matures throughout 2024. So 10.8 plus 2, yeah, I don't know, somewhere in the realm of 13 plus trillion dollars that is going to come out of the Treasury Department in 2024 that needs to be purchased by someone in order to fill the coffers of Treasury to pay the maturing Treasury instruments that are maturing around the world. How are they going to do all this? What are the implications of them doing all this? First and foremost, why would they do all this? Well, to keep things running. If they don't do all this, things stop running. And your best friend's going to be Immortan Joe in a post-apocalyptic society because he controls the water. So that's literally the binary reality of our lives. If they don't do it, that normalcy that I've often talked about ceases to exist, and it becomes a world of survival. And can you literally acquire consumer staples? And then you got decay of social order and chaos. So it comes back to the title of the stream, the deal. And the deal is actually pretty simple. The U.S. has to prop up the yen, which means they're propping up Japan. Why? Because Japan buys our debt. China doesn't want to buy our debt anymore. Russia can't buy our debt anymore. And the rest of the world isn't economically profitable enough to buy the amount of debt required to finance U.S. fiscal policy. I mean, technically, they could pull a full on MMT and just instead of borrowing capital from the world, they could print it. But then that just destroys trust, just obliterates it, and that's the end of the world anyway. And that's what MMT folks never said. Like we saw that video circulating last week. If why are they borrowing? Wow, if we could just print it, because if you could just print it, there's no trust. You've destroyed trust. That's exactly why we borrow. And then the world started using those debt instruments to print the dollar anyway. Interesting, huh? So U.S. buys yen, Japanese firms continue to borrow yen denominated and purchase U.S. treasuries. And that is literally the observation we've had in crypto markets with the relationship between interested parties that are currency producers, as we've described with these federations more specifically, and how you're able to have a consumer disrupt, sterilize excess supply. And in this regard, the excess supply is U.S. Treasuries. And by disrupting excess supply, they're financing U.S. fiscal policy, and that seems to not be slowing down anytime soon. The only way you're slowing down fiscal policy is discussions that Luke Gromen talks about the best. It's literally slash defense spending and slash entitlement spending. And there goes your election by all politicians. No one's getting reelected if they slash Social Security 30%. No one's getting reelected if they slash the military 30%. Frankly, I don't even think they can slash the military 30%. We kind of need it as the world is getting a little spicy nowadays, especially. So that's the direction we're heading, and that's the world in which we live. Now, the world in which we live is disturbing, scary, and unfortunate, and there's no way to turn this world off and turn on another world. There is no way to swap in another system. There is no, hello, I want to use BRICS currency versus the dollar. It does not exist. Mechanically, it doesn't work. Debts are expected to be paid. Countries are required to survive, and if they don't, you get decay of social order and chaos, which leads to basically geopolitical conflict and domestic social unrest. So the only path forward is binary, and for us individuals, that binary path forward simplifies the equation. So you're either a prepper, prepping in terms of self-sufficiency, home protection, so on and so forth. Or you understand that in the effort to survive and avoid social disorder, it's not the phrase that all the armchair economists talk about. I mean, clearly, I got my arms on my chair. I'm an armchair economist, but at least I understand the details. It's not, they're just going to print it. That's not what they're going to do. They can't just print it because I literally just described that they print it, trust is gone, and then that just causes the collapse. If no one trusts the dollar, then it just falls apart. Then no one's going to buy the damn debt. If they're just printing to pay the debt, what's the point? We might as well just issue the debt and buy our own debt, which is not what QE is, but people like to think that's what QE is. So they can't just print it. So Japan actually seems like the most interesting country to prop up, because all of this is about propping up other countries. Why? Other countries have built the deepest hole imaginable of dollar debt. So literally, we need just a deal with any one of them to prop up their currency with assurance that they're going to continue to buy our debt. And that's disgusting, but that is what's going to play out. Otherwise, everything unravels. So the most likely target is Japan. One, they're already an ally. Two, they're the largest, or aside from China, which has been decreasing everything that they own with regard to the U.S., they're the largest owner of treasuries already. Europe is not in a position to do this. They're too damn fragmented. Japan is a very honorable country. Their culture is extraordinarily honorable. And I think that makes them a great ally. And they're in the East. And they're in a wonderful position to facilitate sterilization requirements for U.S. long-term debt issuance. Because all they need to do is prop up the yen with regard to U.S. Policymakers. And then the market in Japan is literally going to do the rest. And it's still going to get gross because of the amount of debt issuance and how parabolic it's going. The interest being paid on the debt is literally just flooding the world with dollars, which stabilizes the system cyclically. So that's exactly what we've been experiencing for the last 14 years, right? Cyclical stabilization where capital starts to expand, and you see that first and foremost in crypto markets. And then the decay, where capital is no longer expanding, currency gets scarce, businesses start to fail, human resources pull back, and there's your cyclicality. So as long as you understand the cyclicality, you basically have a sense of timetables involved in how to grow your capital, how to manage and navigate these markets, and buy things at a discount, and know that they're going to appreciate when the global currency cycle starts to occur. That's what everything I just described from the start of the stream is reduced to the phrase the global currency cycle. There's nothing else. And Raul talks about this, and I reduce it the way I understand it based on everything I've learned from other economists as well. And I call it the global currency cycle. Think of it as a balloon expanding and contracting, and it's all about avoiding a Morton Joe who's lurking around the corner when the debt system finally collapses. And investors investing in the debt system finally collapsing, where Bitcoin is the only thing left with value, and the people without Bitcoin are poor and frustrated and angry and violent and starving. And those are the boys that are asking a Morton Joe for water. And then the folks that have the precious Bitcoin are able to battle through hordes of the people without Bitcoin to acquire the one or two products on the shelf at the supermarket for sale denominated in Bitcoin. Oh, no, no, no. The world is a very scary place if the currency regime of the planet fails. And there is no instantaneous way to turn on a new system. These types of processes are like celestial phenomena. They take years and decades, maybe even a century for this shit to play out. Because believe it or not, if someone is owed $1 trillion, that motherfucker wants to get paid the money that's owed to him. Period. The person who lent money wants to get paid. I mean, it's kind of simple when you put it in terms that I think of and I tell you guys. That's why it will continue. Someone lent money, they want to get paid in the denomination that was lent to them. They're not going to accept pesos or rubles or yen or yuan. They're like, no, dude, I lent you this. Pay me this. Think about you. You lend someone $100 and someone wants to pay you in gold. I may be sure you catch a deal. I mean, the entire topic of this stream is a deal. But that's at the margin. What about the majority? The majority don't want a deal. The majority lent in that denomination. They want to get paid in a particular denomination. Period. No ifs, ands, or buts. So that's why the system will continue, and that's why the entire navigation of the system reduces to a binary reality. And Morton Joe, where the game goes on and the deal is made. And that's the bottom line. DXY hovering at around 105. Let's take a look at Japan. Japan smacked right into the daily 50 SMA. I mean, literally, it's absolutely remarkable when moderate term moving averages get hit like right to the tick. And it's especially remarkable when long-term moving averages, which we don't have at this point, for the yen. And I would expect further yen intervention, with the inevitable yen intervention having to come from an external party. The only person, entity on this planet capable of achieving a sustained yen intervention is actually the person who has a capacity, entity that has a capacity to print the currency units that they're literally looking for. So they want dollars, so they're buying U.S. debt, which pay dollars. Wild cards all over the place. Russia and China obviously are the biggest wild cards. But bear in mind, as much as people have a particular opinion for Peter Zeihan, I think he offers great insight into geopolitical strategy. I don't think he offers the best opinions with regard to economics, which makes sense. He's not an economist. He's a geopolitical strategist. But I find his insights very interesting with regard to especially demographics. I think that is kind of unquestionable because demographics is a very causal observation. Population is either increasing or decreasing. What's the birth rate? What's the composition? Literally, oh, no, I'm not talking about Dominican stuff. I'm talking about the composition of a population. And the composition of a population is critical with regard to a capacity for that population to be productive or retired and consuming. So I think those types of insights that he offers is quite extraordinary, as well as the military insights because he has access to intel and stuff. So I don't diminish almost everything that he talks about, except when he steps out of his comfort zone. So that's it's imperative that you listen to other people aside from myself, albeit obviously I distill everything that these folks talk about into a consolidated presentation that I offer to you 3 times a week on this stream. How's debt doing? A little bit of bid across the board on U.S. debt. Long, especially the long end 2 month, that's stable, 0.09%. Oh, goodness gracious. Nothing really to inspect there. It's basically along for the ride, sticking to Fed policy. Basically, this chart says that short duration U.S. debt um, bills and notes are respecting the Fed. They still respect the Fed. And that's important because if the Fed loses control, shit's hitting the fan. Anything else interesting? Oil at 78. Damn, that was up at 88. And UK oil was above 90. European oil versus US oil, obviously more of a premium on UK oil. International oil, as it's more volatile overseas and a little bit more predictable in the self-contained entity of the United States, which is completely self-sufficient with regard to oil availability. Only if they could get the oil price and the oil drillers and refiners into a favorable arrangement, which is not so easy unless they nationalize the shit out of everything. Because obviously too expensive and you're crushing consumers, too cheap, and oil drillers and refiners can't finance shit, especially in the face of consumer price inflation, labor cost, and their supplies and materials required for drilling as well as refining. 23.24 on gold. Gold sees through all the bullshit, and the fact out from this multi whatever high indicates it's smelling a lot of potential uncertainty on how things play out, and it's just reflecting here. People are flocking to gold, probably driven significantly by China and their efforts to de-dollarize, but they're not de-dollarized. There's no such thing as de-dollarizing in a world, especially a Chinese world, that owes a significant amount of dollar debt. They need dollars. So change starts at the margins, and clearly the behavior is representative of these marginal changes. But at the core, and that's imperative with regard to time horizon, at the core, the game goes on. And when you see the change that they've been presenting, all right, give it a decade. Check back in 2035. All right, and we'll see how much progress has been made. That's the biggest thing folks get wrong with regard to engaging with markets, the time horizon for an expectation. Oh, the dollar's going to fail. Oh, well, first you got to understand what the dollar is, and you got to understand why the dollar isn't going to fail anytime soon. Or when would you check back for a progress update? So the expectation that the dollar is going to fail happening anytime in the short term is quite unreasonable. Mechanically, rationally. Check back 2035. So this game will continue, and I think a decent time horizon, an interesting time horizon for inspection, really is the way Raul thinks. 6 years for the AI singularity, and that's quite intriguing the way he talks about that. And I understand it overwhelmingly, and I think that is a decent time horizon, considering rates of progress They're basically double exponential. And it's going to change the face of productivity, employment, everything. It's going to change everything. So 6 years is a very interesting time horizon for a variety of expectations. Check back in 10 years with regard to global currency, the global currency regime. And nothing's going to significantly change in a 10-year time span. But 20 years, you could have a very different flow of capital around the world. You know, especially after the singularity, as Raul describes it, because that's going to change everything. This is probably a good representation of why we've had lack of Bitcoin appreciation, broadly the cryptocurrency space. Financial conditions have been tightening over the last couple of days and maybe a week or two. This is the first uptick in quite some time, first uptick in financial conditions since August of 23. Oh, very interesting. So policymakers will inspect, can the system sustain it? This is the tightening cycle that the Fed would love everyone to believe is a manifestation of their interest rate policy. Raise interest rates, raise the Fed funds rate, and it tightens the availability of currency supply. And it did back in 2021, but then it just started loosening and it just fell off a cliff. Now these tightening waves last, nothing like 2 months. This tightening wave in August of 2023 lasted until October of 23, and that was it. And then boom, fell off a cliff because October. So this really wasn't, here, check it out, March of 23. Very interesting, huh? What was in March of 2023? U.S. banking system failure. It's imperative to look through the bullshit with regard to Silicon Valley Bank and the other ones that failed. And we've had recent failures as well, because it gets viral really quick. The bank runs start at the margins, and then they become systemic. So massive intervention of liquidity back in March of 2023, visually obvious on this chart. There goes the liquidity spigot, or these availability of capital as it's needed. And it's been going down ever since. And at some point, all things considered, this has to go down further heading into the end of the year. Otherwise, what the hell is going to happen with commercial real estate? Period. It's just going to just fall to pieces, and that'll bleed over into the banks, and there you go. You're back in March of 2023, where banks' balance sheets that are already impaired are blowing up. So basically, my sense is that what they've been doing is buying time. Buying time and yelling at every single bank to get your shit in order and figure out how to solidify, not solidify, but stabilize their balance sheet such that on paper, from an accounting perspective, they present as solvent under increasing duress. They had basically no wriggle room in March of 2023, and shit became insolvent. The numbers have to crunch, otherwise the regulators step in, because the general public has access to the numbers. So if the general public sees something as insolvent and they don't see a regulator stepping in, obviously trust gets destroyed. So the regulator has to step in. And that's where we are. If commercial real estate isn't effectively papered over and the banks haven't managed their balance sheet effectively in order to absorb these losses, regulators step in, and there goes the liquidity spigot one. And if enough gets destabilized, you get the cascade effect, and that's clearly something they not just want to avoid, structurally they need to avoid that. So at some point this rolls over yet again. Treasuries got $917 billion just of cash just sitting there. So clearly that's part of the tightening. That is capital that has been withdrawn from circulating financial activity. At some point, that is going to get drawn down. Where's the RRP? RRP's up at 450. All right. I think I saw that over 5. But that seems to be trying to express a bit of a lower bound with regard to consumption of RRP services. It's very interesting because RRP, Treasury General Account, And obviously, the Fed's balance sheet contribute to the the effect that these accounts have on currency composition domestically in the United States. Uh, it's kind of is that, and that is imperative to understand that couple of sentences I just said, because there is no money printer go burr at the Fed. That is a mean, it's effective, it's emotional, and I've talked about that earlier in the stream as well. But you have to look past it and understand the mechanics of what it's doing. Because the better you understand these mechanics, the better you're going to be able to see the pressures in the system and why they have to do certain things, and you understand the binary reality of the financial system as we know it, which means at some point everything goes absolutely ballistic because liquidity is added to the system to keep the system running. Banana zone, as Raul calls it. And the banana zone has to come. A 2 trill run rate on fiscal deficit spending and 10.8 trill in refinancing obligations and the required intervention to keep the sterilizer functioning. That's all going to take liquidity, as Mike Howell inspects. And we'll see that in the data. We'll see that in the loosening of financial conditions. We'll see that in the drawdown of the Treasury account. We'll see that clearly in gold prices as that's going to behave this positively, seeing all that regulator activity. And clearly we'll see it in the crypto markets because that'll sniff it out much faster than gold can. Anything else interesting down the watch? Down the watch list. Look at me, I said it backwards. Down the list of the watch. I'm speaking too much Spanish. Everything is backwards. VIX crush. VIX kind of stable today, 13.81. It was crushed heavily Friday. That thing was up at like 15, 16. It was crushed down to 13. So today, I would say this is probably stable. I think VIX crush is a lot of people are looking for this line break, and they chart the VIX, and it got crushed on Friday. And I think that broke trend to the downside, the way some folks chart the VIX. And I think that kind of invalidated some interesting fractals that people have been looking at over the years. But VIX crush is still in play. And this is a manifestation of everything that's required to keep the global collateral system liquid and the global currency composition actually functional. So VIX crush, and you clearly see that exacerbated in the UVIX because that is a levered instrument. Where's natural gas at? Natural gas has flooded the market. I'm sure that's pretty much down at this point here. Yeah, look at that. Remarkable. Just a lot of supply of nat gas, especially domestically in the U.S. because of the shale oil production process. I want to look at a couple of crypto stuff. I want to look at stable coins. 160 bill, solid uptrend, leveling out a little bit in the last couple of days. 0.25 marginal positive sum environment. A little more granular inspection, 81 bill, negative sum on mainnet. Take a look at base, positive sum up to 2.8, kind of slowing down. Really ripped to 2.8 real quick. 10% week over week is massive. 12.68% up to basically $9 billion worth of dollars. Presents probably the most interesting market for financial activity in the crypto space other than mainnet with regard to dollar supply. Binance Smart Chain 5.123, positive sum environment 7.48%. Looks like there's been significant capital rotation off of mainnet into L2s and alt L1s. That is a perfect example of that statement. Avalanche has been quite resistant to capital flows, but whenever you see Avalanche start to have a positive sub-environment, that means capital is starting to rotate off of mainnet into the alt L1s and L2s. Let's see Phantom. Slightly positive sub-environment, 400 mil. Phantom compared to Optimism. Wow, Optimism up to a bill, 2.55% on the week. Let's look at our smaller networks where we have exposure. 10%, small potatoes compared to optimism and stuff. Monet and Mantle I like to look at. Positive sub-environment, 15 million stables. Let's look at volumes. Then I'll get to you guys' comments. We'll try and keep the stream under an hour and a half today. So that's very interesting because we have a marginal positive sub-environment in the crypto space with regard to dollar supply. Yet we have decreased volume. What happens when the volume picks up with a greater composition of currency spread across the crypto markets, especially in markets that are L2s and all L1s that have basically zero transaction fees? You get significant increases in volume. So this is a red herring. This doesn't tell the whole picture. This tells the immediate, but availability of currency coupled with the cyclicality of volume means we're heading into increased financial activity. So the dollar supply really tells the full story. Mainnet slowing down, optimism. Very interesting. 21% week over week. So when you see the increase in dollar supply on optimism combined with an increase in volume, that is double, a double, that's confluence. So it's very interesting what's going on in optimism. Binance Smart Chain significantly slowing down, Phantom slow down, Avalanche flat, Arbitrum flat, Base. Very interesting what's going on Base. Massive increase in dollar supply, but look at the volume. That is a significant roll off on volume from a peak at $600 plus million. Is that today? No, that's May 4th. May 4th down to less than 300? No, less than 200 mil in volume. 186 mil. That's a massive roll off in volume. So logically, the causality of a significant decrease in volume is going to be a significant decrease in financial opportunity. Meme coins are going to roll over because if meme coins aren't going up, they're going down. It's the nature of the beast. And as I've talked about before, you'll have a concentration into the few significant meme coins that will survive on base. And obviously, Aerodrome experienced a significant decline, which is very consistent with the rollover in volume. Very obvious rollover from top at 233 down to the 382 on the fib. Very consistent with the rollover in volume. Where else is interesting? Let's go over to the small chains. Linnea with their consensus narrative. Minus 2.91% on the week. 27 mil. That is a healthy volume for a microscopic L2 that has less than $1 million in stablecoins. That's a lot of volume. Take a look at Mantle real quick, and we'll get to the questions. Mantle 18, so good volume, positive and on the week. Very interesting networks. I wish I had more insight into Cosmos hubs. You got like Kava and stuff, and what's Kava doing? Let's take a look. It's microscopic, 1.6 mil in volume. I wish I had more insight into Cosmos hubs. All right, let's hit some comments. See what you guys are thinking about what's going on. Topsy's in the house. Enjoyers. Much pleasure, my friend. Trantaloy, good morning. Cap. Robert H., good morning. Loved the yelling. Better check with me first before intervening, right? Isn't that interesting? Who's holding the cards and really what does she mean by that? And it's quite obvious. And I hope it makes sense considering the entire conversation we had on today's stream. Interesting stuff. Raul, pleasure. Hello, Diego. Hi, sir. Present. Nice shirt, Cap. Thank you, Noah. Yes, Noah. Thank you, Noah. I'm Noah. We're all Noah. We're Dominican Noahs today. Much a pleasure. Patrick Ford, whether anyone likes it or not, the dollar is lubricant of global markets. Yes, and obviously so much of what I talked about earlier in the stream, everyone has borrowed in dollars. It was an opt-in organic phenomena where everyone literally just borrowed in dollars. The amount of dollar debt on the planet is staggering. Almost $300 trillion, I believe, is a relatively accurate statement. And when you borrow in a dollar, the guy who lent it to you is expecting to be paid in dollars. Arrows in the house. Much a pleasure, my friend. Mix, mix. Yes, indeed. Quite a system we live in. Lasker, hello, Noah. Any idea of realizing market caps of VE33 DEX and Bull Run? Uh, no. I mean, even the most astute on-chain data analyst, he can't expect particular market caps, which means price points are just might as well be shooting darts at a dartboard. So, I mean, that's the nature of trading. You want to buy at a low price, sell at a high price, but you have no idea where the price points are going to be. So that's why traders don't use price points other than from a technical standpoint. So you're bringing up kind of thoughts on how traders are required to engage with the market using rules. And levels are significant because they offer you past behavior, and ultimately a chart is a manifestation of collective behavior of market participants, so levels are significant. They tell you where actors are more than less likely to engage, where they're likely to buy, where they're likely to sell. First on the list is levels of significance. So the longer a chart history, the more information you have to make better decisions. Second on the list is moving averages. Very significant. Everyone looks at the data. They see the moving averages. The nature of reality is mean regression. So that's what you see play out on varying time frames on technical data. Third on the list is technical trends. Technical trends don't really have significance, but they kind of give you maybe an insight into trend behavior. Technical trends, trend behavior. So social media, and they give you a capacity to inspect the likely behavior of people. Third on the list, levels are the most powerful, moving averages. Second, technical trends. Third. Technical analysis 101. Hope that helps. Athletic concept. What's up, Cap? How you doing? Adam, hey Cap, any interest in friend tech? Similar ideas to what you were thinking, meme coin to pay for Discord? Maybe, but generally speaking, my sentiment about where we are in the markets is we're at the end of investor season. If you could find a discount, maybe it'll warrant acquisition, but generally, what does the end of investor season mean to a person like me? I'm done. I have my positions. I have nothing left to do but manage the businesses. Um, no more purchases that I'm really scoping. My portfolio is a manifestation of exposure, and I have exposure to markets. I think in terms of markets. And why? Markets have people. People have capital. Capital seeks out opportunity, which creates volume. So which markets are going to experience volume? I think we've hit them all the meaningful ones. We haven't discussed too much on Discord about exposure to like Cosmos hubs, but we have, like I've talked about the Atom position, but I've had that as a legacy position. So it's not really relevant to like business activity. I don't really talk about validators as business activity. Most people don't stake at the validator level. Most people aren't running their own validators, very few. So we mostly talk about broadly DeFi businesses that are offering a capacity to capture volume in markets, which is why I've reduced my portfolio to how well I am exposed to varying markets that can experience interesting volume over time. So at this point, I don't see the need for necessarily any additional exposure to markets. So unless I'm able to acquire something at a good price, an extraordinary discount, it's just not something that I'm interested in, which is very interesting. And this is obviously a much more mature perspective on how I engage with the markets now versus historically, which means we're heading into this bull market as a novice to describe it, and I'm like, I'm done. I mean, and I find that quite interesting. I'm done before everyone's about to get started. And I said in 22, we're not going to have anything to do in the bull market. You don't buy when the number's going up. You don't buy when shit's going parabolic. You're not adding to businesses because there's no discounts. So when the bull market hits, you're sitting back and just watching and doing what Buffett does. Buffett owns his businesses and he's got a stockpile of cash and he accumulates, waiting for the prices to come down hard. So that's the plan of action for the bull market. Everyone's running around chasing the number that goes up and creating volume, producing transaction fees, borrowing credit, paying interest. And as we've described it, I was sitting back accumulating, and the bank account fill up, letting the cash hoard pile up. Won't be like Buffett, but this is structurally what he does. And he hasn't found discounts. If he found discounts, he'd be buying shit. Because that's the way it works. That's the way I describe it, and that's clearly the way he behaves. Otherwise, he wouldn't have the capital. If you have the capital, it's because he didn't have something to buy with it. Isn't it obvious when you put it into this conversation that I offer? That's why he has the cash. Why does he have a cash pile that's melting, not keeping up with consumer price inflation? Because he doesn't have his discounts. So if I am going to engage the way Buffett does, because it worked for him, and it will work for me. And it worked for anyone, because it's very rational. Very simple methodology. Buy shit when it's on a discount. Stop buying shit at a premium. And let other people work for you. So when this bull market pops off, everyone just trading is working for us. Because that's the type of exposure we chose. Hope that helps. So maybe Adam Frentech, but I don't know. I don't really have the puzzle pieces to do what I want with regard to like a stable coin, with regard to a token, a cap token, whatever. In my opinion, I think Spritz Finance is very interesting, and I think that serves really functionally what I need for Discord, where people can subscribe to Discord using crypto payments. So Spritz is the solution for that. Mixed time horizon is everything. How else can you sit here today and be comfortable if you do not have reasonable expectations for what's going to occur in a month, in 3 months, a quarter, in 6 months, a half a year? How can you be comfortable if you don't have a sense of what's coming? The likelihoods that can play out, the paths that lead to the destination. The better you understand it, the more comfortable you could be, and that allows you to let time pass. And this is all about putting quarters on a railroad track, waiting for the train to come. It's going to come. Just got to put the quarters on the right railroad track. Or, oh, you're late. Everything's going parabolic. The trains are passing left and right, and you're throwing quarters at the railroad track. The odds are not stacked in your favor engaging with markets like that. Would crypto ever be used in fitness? Maybe the workout machines generate energy to power something? Yeah, there's a whole lot of fancy shit that we've talked about over the years with regard to blockchains, and ultimately blockchains reduced to metadata. Do you guys remember like 16 and 17? Remember the likes of like Patientoy? Ptoy, P-T-O-Y? I'm bringing out some old crypto token names. Yeah, you could revolutionize healthcare by storing all your patient information on your ledger, on the blockchain, because that's what NFTs are. We didn't really talk about NFTs back in 16 and 17 at all. But nowadays, that's what an NFT is. It's just a mutable way to store metadata, where the NFT itself is immutable. It's non-fungible. You can't break it down, but it can contain data which can be mutated. And that's very interesting from like a computer science standpoint and how we build mobile applications, web applications, so on and so forth. Hope that helps. And of course, it could revolutionize fitness. It could revolutionize everything. It changes everything. It does. And that comes down to businesses making a product that offer a service for people to consume. To consume a product, people need to pay, and there's your cash flow. So unless you have that kind of exposure possible, you don't have opportunity. Find the XYZ. How much does it cost? How much is it paying? And how likely is it to continue to pay? It is much easier to engage with markets using XYZ because it's already paying. And immutable deterministic code is going to continue to pay into the future. If something isn't paying right now, you're speculating that it will pay in the future. Increased risk associated with that. It's much easier to see something that's paying now and assess whether it is likely to continue paying into the future. For instance, mutable, deterministic, paying now, in the future, there's 100 times the volume on the network or the market, you're going to get paid more. Volume goes down, you're going to get paid less. Volume goes up, you're going to get paid more. So now you've reduced the entire business model to volume up, more income, volume down, less income. And that means buy more exposure over time. Accumulate the cash, wait for the discounts, buffet the shit out of the market. Thoughts on scroll? Down the road of what we did with like Linnea and Mantle, small, what is it, ZK? Interesting. Zero knowledge proofs are very interesting. But choose your exposure. Frankly, I think there's some interesting liquidity mining type opportunities, which I'm sure you're referring to. Why not have exposure? Because liquidity mining is a relatively free opportunity. To top it all off, I think we already have exposure vis-a-vis Ramses, and that's the whole point. That's literally the whole point of the things we've talked about probably in the last quarter plus, heading into early 2024. If you recall specifically, Arrow, at the end of 23, we didn't really do much. It was very curved narrative, made that. But then starting in 24, we're like, what kind of exposure could we have to the L2s, the Alt L1s? And frankly, in hindsight, I feel right now, what else could we possibly need? We have full exposure to Arbitrum orbit spheres. We have full exposure to Optimism superchains. We have full exposure to Fractal, which basically is a superchain, Optimism superchain. Downstream exposure to Consensus. Clearly, they have a lot of capacity and interest. Downstream exposure to what Mantle's working on, and Athena exposure, and Bybit narrative maybe. So there's exposure there. That's marginal. But look at all the exposure. No more work to do. The market will do the work. Super simple. Keep it simple. And by understanding the financials, we can let the time pass and those conditions will come. Mix. As we're getting close to the end of the stream, 235 people on the stream between YouTube and throw them in the chat. I'm more than happy to get to any last remaining questions before we wrap things up. Mix, plant the quarters, leave the pennies. I mean, why throw? If you're going to throw shit at railroad tracks, don't stop throwing stuff at railroad tracks. Put stuff on the tracks. Be methodical. Be strategic. And understand the world in which you live rather than not even guessing. It's just autopilot. It's really why the Matrix is the best metaphors for this reality in which we exist. Don't just be plugged in. Unplug yourself and understand the way the world works. I think that will help you be more comfortable, more productive, and achieve better results. Hey, Santi's on the stream. How are you, my friend? Welcome to the stream. You know, I talk mostly about mentality, psychology, and a different way of engaging with markets, which is not necessarily for everyone. Technical analysis, trading is a very methodical behavior, data driven, and I have a high opinion of being quantitative. So as much as we focus on the way I manage capital, that may be a destination for a lot of folks, and that's a-okay. Uh, Obviously, with smaller amounts of capital, it is required to engage with markets differently. I'm going to end the stream on this note, but I think it's very pertinent because a lot of folks that are just getting into the way I talk about markets don't have the capital to engage with markets like this. So, you know, you have 5 grand, 10 grand, and you're trading, and you can make big multiples, and that's how you build capital. And once you build the capital, then you can think in terms of businesses and cash flow. So the trading, I just want to express to everyone, needs to be done methodically as we come into the end of the year and the global currency cycle. You're going to start to see things go absolutely parabolic. And that's exactly what we saw at the beginning of the year with meme coins. Again, 1,000x, 10,000x on the money, but there's nothing methodical about it. So as the traditional traders strongly express, you need your data and you follow your rules. Find the order flows. Look at the books. Look at the L2 data if you're doing it on traditional indices, equity indices. And if you see a skew to bids versus asks, you're clearly going to have appreciation. And then the question becomes, what's the measured move? If you see a skew towards bids, how far is it going to go up versus what's the risk if a load of bids comes in and how far can they push it down before you see some order blocks, they're going to throw some bids and create a floor on the downside potential move. You have your potential gain to the upside, your potential risk to the downside. And as long as this behavior overall becomes methodical, rigorously executed, it's not what's the upside, it's you're out at a particular upside. You are out at a particular downside. And if you rigorously follow these rules, the odds are you'll succeed greater than 51% of the time of these trades. And if you succeed 51% of the time, you will make money. And if you make money, if you make enough money eventually, you could start to engage with markets differently because you're able to purchase your freedom, freedom of choice, freedom of behavior. And that's everything. Life is all about freedom to make these kinds of choices. And you need a certain amount of capital to have different degrees of freedom. And that's just the truth. Monday, May 6th at 12:29 p.m. 239 people made it to the end of the stream between YouTube and X. I appreciate each and every one of you. Hot topics, hard topics, complicated world which we live in, but you've all stuck with me over the years, and I think this is going to be a very interesting conversation about this time next year in 2025, and I look forward to seeing all of you do well. It's Monday, start of the week. I'll see you guys on Wednesday. I wish you all a good one. Stay rational. Peace.